Richard Hale, a man known on Wall Street as the Ghost Trader, once lived a life far removed from the billion-dollar empire he eventually built, and the story of how he accumulated his wealth is one that he never shared publicly until the night he walked into the silent trading floor of his now empty hedge fund building and decided to record everything on a confidential tape, a confession meant only for the next generation of traders who would one day attempt to replicate his success without understanding the price he paid. He began by explaining that he started with nothing, no connections, no mentors, no capital, just an old laptop, a $600 savings balance, and a burning obsession to decode market behavior, spending nights reading SEC filings, dissecting the trading patterns of legendary investors, and studying the psychological loops that drove fear and greed in the stock market. He confessed that his first big win wasn't brilliance, but luck. A small-cap biotech company that announced unexpected FDA approval, and his $600 turned into $8,400 overnight. But the high from that win blinded him, tricked him into thinking the market rewarded confidence instead of discipline, and within 3 weeks, he lost everything chasing a momentum stock that collapsed faster than he could click sell, forcing him to accept that the market punished ego more brutally than bad decisions. He described how he rebuilt himself by treating trading like an engineering problem, creating a system to track market cycles, institutional money flow, liquidity traps, and the subtle patterns behind pre-market manipulation, and how he spent 3 years living in a cramped apartment, surviving on instant noodles, while coding algorithms that scanned for insider accumulation, unusual options activity, and after-hours price anomalies. He recalled the day his life changed. During the 2008 financial crisis, when fear and panic ripped through the global markets, he recognized a rare pattern. Stocks with strong cash flow collapsing not because they were weak, but because the entire market was drowning in fear. So he borrowed $80,000 using credit lines and margin, a decision most called reckless, and placed massive but calculated positions on companies that still had solid fundamentals. And when the market finally recovered, his portfolio exploded from $80,000 to $4.6 million, an overnight transformation that made him arrogant again, pushing him to launch a hedge fund before he was emotionally ready to manage other people's money. He admitted the darkest part of his journey, the year when his fund lost $72 million in a single quarter after he misjudged a geopolitical conflict, triggering a chain reaction of panic withdrawals, lawsuits, and public humiliation, leading him to isolate himself inside his office and question whether the market was a game only designed to break people who underestimated its cruelty. But he slowly realized that every billionaire trader he admired, whether Ray Dalio, Paul Tudor Jones, or Stanley Druckenmiller, had gone through catastrophic failures of their own, and the difference was that they didn't quit. Instead, they evolved, learned, and rebuilt from the ashes of their mistakes. Richard then explained his final comeback. He returned to the market with a new mindset, no longer chasing money, but focusing purely on discipline and probability, scaling slowly, protecting downside risk, and studying macroeconomic cycles instead of short-term noise, eventually identifying a generational opportunity during a massive market sell-off caused by inflation fears and tech stock liquidation. He placed a series of long-term, deeply researched bets in undervalued AI infrastructure companies, energy storage firms, and cloud security giants, and over the next 6 years, those positions grew into a staggering fortune worth over $1.8 billion. In the final minutes of his recording, Richard stated that the world celebrates the billionaire outcome, but never the sleepless nights, the emotional collapses, the silent failures, and the internal battles that shape a trader into someone capable of surviving in a world where one wrong decision can destroy a lifetime of work. And with a tired voice, he concluded by saying that wealth doesn't come from predicting the market, but from surviving it long enough to understand its rhythm.